Hey everybody, making a quick little video here to do an update, just to show you what I've been doing the last week or so, how my portfolio looks, and how I'm approaching the next week and the next month or so. So from my last video, you're going to notice a sizable, very sizable jump in my net assets exposed to the market right now. Um, that would be because I took I took a loan from a friend. Um, and probably 90% of the people out there, this is not recommended because um, the normal way that if you ever look this up, a lot of people don't recommend this, and the reason why is because you normally don't like if the market drops or something like that, you don't have an ability to pay back, but because I have this is a very specific situation to me. So I have the credit available and I have a stable job and whatnot. So it's normally not recommended, but unless you're in a very specific circumstance. In my circumstances, my house is paid off. Both my cars are paid off. So effectively, I have just, you know, my core bills, which is like a phone and water and whatnot. So it's a very specific circumstance, so do not take this as advice to go take out a loan because one thing that we did see a lot of people doing, or a lot of people were doing during the Bitcoin craze, when it was going up to 20,000, they were taking out 20,000 on a credit card and then dropping it into the market or something, and then just assuming they would always get their money back. This is why it's never recommended to do that, you know. But in my situation, I have the remaining amount. I have the portfolio. I have money on the side. I have net worth. I have equity um, that I could recover my funds if the market dropped to zero or something. So, with that said, this is that's so what did I do with the money? So, one stock that no matter who you look at across the dividend growth investor portfolios, YouTube, people that do blogs, just recommended. So they always recommend Realty Income Corp. I've been tracking Realty Income Corp or Corporation for a little bit. I was hesitant to get into it because it seemed like it's highly valued. It's very highly valued. Sitting at a 59 PE. I know there's some people out there right now that's like nails on a chalkboard to them when they do that. The only thing I use that is just a way of to try and gauge if the stock is expensive right now. Um, I know that doesn't necessarily mean too much about their actual earnings, and you have to go with their forward payout ratio and whatnot. It's a very complicated subject. If you ever watch Dividend or uh, Gen X Dividend Investor, he has a video where he breaks down his holdings. One of them is Realty Income Corp. It's about 45 minutes. It is extremely detailed. And I even told him on one of his recent videos, I'm like, you got me to drop some money, a lot of money in the O. So I dropped a good chunk into there. Um, Another reason I dropped it in there, um, if you look at my last video, I like to drop close to dividend or ex-dividend dates so that I can get in to get the next dividend. So it made sense to drop it in here instead of something like, say, Disney, which just paid out, by the way. So it's not going to have an ex-dividend date until sometime in June. Um, so what that does, so little things I'm going to be moving around when the market opens again. So as you can see, dropping that much money into one stock with the way that my portfolio looks, if you look at the way that the values are broken down here, so puts a very large portion into REITs. Normally that's never recommended. So what I've decided to do is, and you can see it's a very large portion of that. So what I've decided to do is on Tuesday when the market opens, I'm going to put in a sell order to get rid of this 842 here. that I have invested in SRAT, take the profits on that, and then probably either drop it into Disney or another single name like uh, um, another single name I wanted to show you here. Something like Pepsi, for example. This is my watch list. It's at a 17 PE when the rest of the market's at an 18.5 PE, um, which tells me that there's room to run. Now, would I prefer to drop it closer to the ex-dividend date? Yes. Is this money that I'm just going to let sit there? Yes. Um, so it's probably I'm going to end up dropping it all into Pepsi. So that's what'll end up happening there. And so that would reduce my REIT exposure back down. It would probably knock about, it would knock a little bit off of my REIT exposure if I did that. So if I did something like that, let's see what it would do. Where's my charts? Not that much off of it, but I'll build up other positions in my REIT section. So I'll take that 842 and drop it into Pepsi, and that would give me another solid dividend stock. The reason why I'm looking at some single names right now instead of ETFs, like I said in my last video, is something that's going on here. So this is something that CNBC had, and I thought it was very, very interesting because some of the people on the Fed are, I don't know what they're doing right now, but they're just disconnected from reality. They're having trouble understanding how the repurchase operations that they're doing are translating into the market. And there's a billion little different theories about why that's happening, but the simple fact is, it is. It just is. Is it doing it because everybody thinks it's QE and it's direct injections of money? The Fed will tell you no. And if you look at the definition of how they define QE, it says no. Is it having an effect on the short end of the treasury where there's so much debt going into the short end that people who would normally buy bonds are saying, hey, give us more than 1.5% or whatever? So the Fed has to go in and basically say, okay, look, you guys buy the bonds. Since we can't buy them directly, we'll come in behind and just repurchase those from you. And we'll even give you a little bit on top of it. Not much, but enough. So it's very clear what's going on here. It's going to have to keep going on. There's no stopping this. This is just the reality that we're in. Until you see the federal budget get their deficit cut in half, probably, this is just going to be a thing. There's no way around it. I mean, it's very clear. Fed starts their repurchase program. They start injecting an insane amount of money. The amount of money that they injected just from 1 or 2 days was the entire worth of what they said that the trade deal would be worth with China. You want to just wrap your head around the numbers that they're putting in. So, and then JP Morgan and them are just cashing in. So if you hold XLF, you're probably pretty happy right now. Or if you hold JP Morgan or Morgan Stanley or just any of these ones that are just benefiting from these investments, you're solid right now. So like I said, next one that I'm going to drop money into is going to be PEP for sure. Just solid stock, 17 PE, so it definitely meets all the everything I'm looking for. Next check, I'll probably end up just buying more PEP, to be honest with you. If the Fed does indicate that they're going to stop this, that would be a really good buying opportunity for a lot of stocks. And the reason why is very simple. When the Fed finally gets it through their head, or they finally admit, and a few of them are finally starting to admit that this is having a big thing, but they don't want to grow the balance sheet, the next step is going to be to lower the rates. Well, things like O are going to benefit heavily from that, which is why if you look at just what the just any of the REITs have done recently, people that are smart know what's going on. They're starting to price in another rate cut. If you look at the bond market on CNBC, for example, they're pricing in another rate cut. The Fed doesn't. The Fed said, "No, we're not going to do anything for the rest of the year." Well, the simple fact is as soon as you pull that money, the market is going to act like you just stopped QE. They're going to do a taper tantrum because the market wants to correct down to where the actual earnings are. So right now stocks are flying pretty high. So the current thing is extended all the way until February 13th. So to protect myself from that, I'm gonna take up positions in O, Pepsi, a few of the dividend aristocrat names. Just kind of slowly start to build up those positions. Um, as I went over in my last video, because the way my tax rate works and just I have you can see my income for a year right there. So I'm well underneath where I would need to be for 12%. So ETFs or dividend payers make sense for me specifically. Some of the other people on YouTube, if you look at their stuff, buying single names 100% makes sense to them because it has to be qualified dividends. It has to be, or they're going to get hammered on taxes. Like their tax rate on dividends would go from, like their tax rate on certain things would go from 12% up to 22% in some cases, as I went over in my last video. So you have to pick a dividend strategy that works specifically for your circumstance. So, and then also once I get my tax return, you'll probably see another sizable. I'll either get into, it depends. I'll either invest it or I'll get into this mode where I like to either, sometimes my debt goes up and then sometimes I get into debt payback mode is what I like to call it. So, sometimes I'll run the debt up and then sometimes I'll wind the debt down. I'm in my 30s. Some people I know in their 30s have $300,000 in debt. This number right here says 300,000 because you have a house, 2 cars, kids' tuition. If you include stuff like daycare in there, that number is like 300,000. So 27,000 for somebody who's in their 30s with a stable job, and I think I'm doing pretty good. So that's why I decided to basically use my credit. Just if I have this sitting there, and it's not that much of a risk at all. So, but that's kind of where I'm at. This is what the pie chart looks like right now. And yeah, just current things that I got going on. I wanted to show you. So, what does that type of thing have when it comes to effects on my dividends per month? So, if I go to historical, prior to me doing that, it was $991 a month, or $991 a year. It went up to $1,651, and I actually need to update it because I did that a few days ago, and it's actually gone higher since then. But so 1,669. So basically, I'm at roughly $146 on the peak months, $152. This is one of those ones where the biannuals pay out. The months where the biannuals pay out is where you're going to see the higher increase. And you can see kind of a breakdown of how everything's working. And if I do it just by a 1 month view, because remember I told you one of my goals is to kind of have once every 7 days getting money. So 50, 48, 59, and this is just the next month alone, $137. So remember, like I said, this is very specific to my situation, what I just did, and it will not take me very long to pay back at all, because I always do extra payments anyways. So, let me know what you think. Give me a comment, whatever, and open to opinions. Slowly, if I ever do see the Fed ever really, really step back, I would go very defensive. because that would tell me that they're probably done with what they're doing, but I just do not see it happening ever. Because I guess we're not allowed to have recessions anymore. So I would be amazed if the Fed ever steps back. 2020 is going to be a very interesting year. Um, like I said in my last video, it's the Fed. I don't see the Fed stepping back at all. The Fed will ride this. They were supposed to stop the repo purchases on January 13th. They extended it out to February 13th. I expect that to fully get extended out to June. Or they're just going to flat out cut rates across the board 2 or 3 more times to juice the markets. And then the market's going to have a heart attack if Bernie wins or something. We can deal with that when that happens. But we'll see how it goes. Yeah, like I said, leave me a comment. Let me know what you think. And then y'all have a very nice day. Thank you.